We received a slew of new economic data for the first 2 months of this year today. While Chinese New Year happens at various times each year, it's typically beneficial to look at January and February together. But this year is especially interesting because it also provides us our first impression of how China's economy is doing after the zero-COVID policy and opening up. How did the economy fare? The best term to describe it would be mixed. The results were about in line with forecasts, but coming from such a low base, they're only positive when contrasted to how bad things were during the zero-COVID era. And as JLL Greater China Chief Economist Bruce Pang stated, there are not many bright spots in today's data. Industrial production increased by 2.4% from January to February, but real estate investment decreased by 5.7% and fixed investment increased by 5.5%. This also helps to explain the significant growth in debt during this period, with aggregate finance increasing by more than 18% on annualized basis in only 2 months. The dip in real estate investment follows a 10% drop in real estate investment for the entire year of 2022. Exports were lower than expected, but there were some bright spots, according to Louise Liu of Oxford Economics lead China economists. Factory output also accelerated after 3 months of deceleration, which is consistent with improving Purchasing Managers' Index data from January to February and reports of easing supply chain bottlenecks. Manufacturing of electrical gear and equipment was a clear bright spot, gaining on a double-digit year-on-year pace. Moving from the optimistic to the pessimistic, Beijing has highlighted unemployment as a key policy concern, and official figures show why. Urban unemployment reached 5.6%, and the rural situation is thought to be much worse. Then there's youth unemployment, which remains frustratingly high at more than 18%. And while we can point to places like Spain as being equally concerning when compared internationally, the average youth unemployment rate in Organization for Economic Cooperation and Development countries in 2022 was around 12.8%, and in the United States, it was less than 9%. Earlier this month, former People's Republic of China Premier Li Keqiang said that China will generate 12 million urban jobs and prioritize the challenge of finding employment for college graduates. But nonetheless, since local governments' budgets have become increasingly stretched, some experts have questioned how many additional potentially unproductive employment local governments can give. And the trend in the private sector is not especially encouraging either. According to Beijing-based Big One Lab, total job postings in China for the 2-month period January through February fell by about a quarter year-on-year, despite the country's opening up. Furthermore, according to a new analysis from the China Center for Employment Research, the ratio between market demand and job applications in China for college graduates in the third quarter of 2022 was just 0.57, compared to 1.24 in 2021 and 1.38 in 2020. A ratio less than 1 suggests very severe rivalry for jobs. According to Zhao Hao, chief economist of Guotai Junan International Holdings, the weak point is from the surveyed jobless rate. The relatively high jobless rate seems to suggest that the further recovery of consumption will hinge on policy dynamics. Hello and welcome to Economic News. If you are enjoying the video so far and would like to show your support, please like the video and subscribe with all notifications turned on. Now, let us get back to the video. Some experts are particularly interested in retail sales growth because it is a strong proxy for consumption, and it is spending that observers and officials are hoping will keep China's economy afloat this year. Retail sales increased by 3.5% year-on-year, owing to an increase in online retail sales of tangible goods. According to Michael Pettis, a financial professor at Peking University, this increase is a welcome respite from the declines that transpired at the end of last year. Although we're all hoping and expecting much faster increases in the next few, the economy is certainly moving in the right direction, and I expect it to do so for the next 2 quarters. But we need 2 or 3 more normal months before we can be confident in our forecast. Several experts agree on the cautiously hopeful wait-and-see strategy. Another quote by Julian Evans Pritchard, who is a capital economics China head, states that overall, the data confirmed what more timely indicators, including the PMIs, had already suggested, that the fading of virus disruptions led in a relatively fast improvement in economic conditions at the start of the year. Goldman Sachs also noted that we expect China's growth momentum to improve further in the coming months, owing mostly to the ongoing consumption recovery and the country's still accommodative macroeconomic policies. We also highlight that 3 years of zero COVID have wreaked havoc on business and private balances, which will take time to recover. Nonetheless, some economists are still dissatisfied with the figures and think that greater financial help is required. Another statement by Zhao Hao, chief economist of Guotai Junan International Holdings, says that China's activity data at the beginning of 2023 was mixed, demonstrating steady rather than accelerating momentum, indicating that strong policy support is required to unleash the growth potential. The Chinese Department of Consular Affairs said on March 14 that Chinese embassies overseas and visa bureaus at ports of entry will begin issuing all sorts of visas, which is another fantastic step for travelers looking to travel to and from China. The government department stated in an official statement that officials will restart visa-free entrance for specific groups, including those visiting Hainan Island and foreigners entering the southern province of Guangdong in routes from Hong Kong and Macau. With the implementation of these long-awaited measures beginning on March 15, China has resumed the issuance of various sorts of visas to tourists and other international travelers. After 3 years, cross-border travel to the United Kingdom is finally becoming more convenient. A quote from Yikai Media states that foreign nationals have faced enormous hurdles traveling to China since March 2020 after Beijing essentially closed its borders due to the global pandemic of COVID-19. Tuesday's announcement comes as China seeks to restore cross-border travel to pre-pandemic levels as the country emerges from its strict zero-COVID policy that took a heavy toll on its economy. Nevertheless, observers point out that the next stage is to increase the number of flights into and out of the nation, since the current scenario remains stagnant, particularly between the United States and China. According to many Chinese financial media sites, due to regulatory difficulties, Chinese airlines have considerably reduced intentions to increase flights to the United States, while American airlines have been cautious to do the same to China due to uncertainties about Beijing's policies. A quote from Caixin Media states that civil aviation authorities in China and the United States capped the number of flights in tit-for-tat measures during the pandemic after China's strictly limited international travel starting in early 2020, and the number of flights between China and the United States is still limited. Even now, most airlines, including Air China, propose to add only one weekly flight. Thank you for watching this video. Please leave a comment down below sharing your ideas that can help China reignite its economy again in a safe manner. Also, if you have time, please do check out our other videos on the channel. Take care now and see you in the next video.